Ever wondered how your business assets, those trusty tools and equipment you rely on daily, gradually lose their value? It's a natural part of business, this concept called depreciation. But how do you keep track of this in QuickBooks? It might seem a little daunting, but trust me, understanding and recording depreciation correctly is crucial for accurate financial reporting and smart tax planning. Think about that shiny new delivery van you bought a few years ago. It was a significant investment, right? Over time, with every mile driven and every delivery made, its market value decreases. The same goes for your computers, your machinery, even the furniture in your office. This decrease in value due to wear and tear, obsolescence, or simply the passage of time is what we call depreciation. Why is it so important to account for this? Well, for starters, it gives you a more realistic picture of your business's financial health. Ignoring depreciation overstates your asset's value and can lead to skewed profit calculations. Secondly, in many countries, depreciation is a deductible expense, meaning you can reduce your taxable income by accounting for the wear and tear on your assets. This can translate into significant tax savings for your business. Finally, tracking depreciation helps you plan for future asset replacements. Knowing when an asset is nearing the end of its useful life allows you to budget for its eventual disposal and the purchase of a new one. So, how does QuickBooks, that powerful accounting software you likely use, help you navigate this? While QuickBooks doesn't automatically calculate depreciation for you, it provides the framework for you to record and track these expenses effectively. You'll need to do a little legwork upfront to determine the depreciation amounts, but QuickBooks makes the recording process relatively straightforward. Before we dive into the how-to, let's briefly touch upon the common methods used to calculate depreciation. The most common methods include straight-line method. This is the simplest method. You deduct the same amount of depreciation expense each year over the asset's useful life. The formula is \frac\text, cost of asset, salvage value, \text, useful life. The salvage value is the estimated value of the asset at the end of its useful life. The useful life is the estimated number of years the asset will be used by your business. Declining balance method. This method allows for a larger depreciation expense in the early years of an asset's life and a smaller expense later on. There are different variations of this method. Units of production method. This method depreciates an asset based on its actual use or output. For example, a machine might be depreciated based on the number of units it produces. The specific method you choose might depend on the type of asset and the accounting standards or tax regulations in your region. It's always a good idea to consult with an accountant or tax advisor to determine the most appropriate method for your business. Alright, let's get into how you can actually record depreciation in QuickBooks. Here's a step-by-step guide. Step 1. Set up fixed assets. First, you need to make sure your assets are properly recorded in QuickBooks as fixed assets. Navigate to the Lists menu. Select Fixed Asset Item List. Click the Item button at the bottom left and choose New. Enter a description for your asset, e.g., delivery van. In the Purchase Information section, enter the original cost, purchase date, and vendor. In the Asset Information section, select the appropriate asset account. You may need to create one if you haven't already. Typically, under Fixed Assets, enter the asset's useful life in years. Enter the salvage value, if any. While this sets up the asset in QuickBooks, it doesn't automatically record depreciation. This is where the next step comes in. Step 2. Record depreciation expense. You'll typically record depreciation expense periodically, monthly, quarterly, or annually. Here's how to do it using a journal entry. Go to the Company menu. Select Make General Journal Entries. Enter the date of the journal entry. In the first line, select a depreciation expense account. You might need to create one, typically under Expenses. In the debit column, enter the amount of depreciation expense you've calculated for the period for that specific asset. In the second line, select an accumulated depreciation account associated with the specific asset. You'll likely need to create this as a contra asset account. It reduces the book value of the asset. In the credit column, enter the same amount as the debit. In the memo field, enter a brief description, such as depreciation expense for delivery van, month of, date. Repeat this process for each asset you need to record depreciation for. Click Save and Close. Step 3. Review depreciation. You can review the accumulated depreciation and the net book value, original cost minus accumulated depreciation, of your assets by looking at your balance sheet. The depreciation expense will appear on your income statement. With that said, thanks for watching, and until next time.